In this video, traders, we're going to look at 5 trading traps to avoid. Stay tuned. Hey traders, a very warm welcome to you. Okay, so I have 5 trading traps for you. I've written them down. Let's go. These are ones to avoid. These are common ones. These are mistakes that I've made and mistakes that you've probably made. If you can avoid these, you'll be well on your way to a better trading month and quarter. Okay, first one is stops too tight. Gosh, you know, I've made this lesson. I've learned this lesson the hard way multiple times, and I'm still guilty of it now. You know, so we want to have tight stops, right? We want to have tight stops. Tight stops equals bigger size equals more profit equals more money in the account. You get the idea. But the kind of bad thing about that is that, you know, when our stops are too tight, we're getting stopped out on a trade that's a winning trade. Not only is that bad from a perspective of losing money, but it's bad from a perspective that we've now chalked that down as a loser. In reality, if we just widen the stop a bit, it would be a winner. US dollar yen in front of you right now, daily chart. You're going long down here. You're kind of some support around here, whatever time frame this was, 2017, doesn't matter. Let's say you went long here, okay, and you had, you know, a tight stop and you got pinged out here on the lows. You would have missed out on a massive move. Time and time again, if you went short here, look, it's a similar type of thing. Went short here, if you got stopped out on that, pinged out on the day, you would be so frustrated. I'm generalizing a bit, as you can see, but the point is go wide to start off with. If you need to tighten up. If you're going to tighten up and add more size on, do that. Play that game as opposed to trying to be right really accurately first time. If we go to, let's say we went to pound US dollar and we go to a 5-minute chart. Let's say we're let me just reset the time scale. Let's just say we're kind of day trading this. You know, we're a 5-minute chart. We're trading them out, long and short. And this is the kind of thing that you get caught out on more as a day trader, I believe, than a swing trader. But you know, if you're trading with stops that are too tight, it doesn't take much for you to get wicked out of a trade. It doesn't take much for you to get stopped out. Give it some room to breathe initially and then look for a broader thesis. Like my broader thesis is for us to push to highs and then reverse back or whatever it may be. Okay, that usual thesis. So instead of saying, right, I'm going to just pull the trigger now and I'm going to have a tight stop, if this is something that is causing you problems, and this is probably something I should have mentioned at the beginning of the video, if you're doing well with your stops and it's working well for you, then don't have to worry about it. Don't meddle with it. You know, if you can get to a position where your stops are perfect, then great. If they're a problem and your stops are too tight and you're getting pinged, try widening them. Try reducing that size. Try scaling into the position to the size that you were going to do anyway, and try adding it like that as opposed to just all in one go. And then see how you get on with it. The other thing to point out, guys, the other trading trap that we've got is you're pulling your stop up too tight. This isn't actually a trading trap. This is part of the stops number 1. You're pulling your stops up too tight before the trade has got a chance to get moving. Let's go back to the yen example. If you were here, fine. If you're on this rally, you're fine. But very often, guys, you know, charts are going to rotate. They're going to push up. They're going to pull back a little bit before they really get going. And if you're kind of really aggressively ratcheting up your stop, you're going to get pinged before you even get onto the meat of the move. Give it some room to breathe. Let the thing take off. Let it get going. When you're in the cruise, you're in the cruise. When you only should tighten stops up when you're coming to the end and you're looking to close a position. You know what? We've hit resistance. You know, we've hit my target. Now I want to just tighten that stop up to protect it, but still give it some room to breathe. When you're in that little takeoff or when you're in the cruise, you want to give it some room. You want to give it some room to do what it needs to do. And if that means getting stopped out from time to time, then so be it. You need to give it that room. Okay, next one, guys, I've got for you is too much noise. A classic one. This, what I mean by that is too many indicators on your chart. Let's just say here I've put volume on. I can put a view up on daily. I can put a couple of moving averages on. Even that just makes me go, I can't see what's going on. But people have way more stuff than that. They'll have a stochastic. They'll have an RSI below. They'll have this or that. Let's stick something else on just so we can get an idea of what we're talking about here. So, you know, they might have a CCI, use a CCI. That just looks so noisy, and people will look at it and go, oh yeah, but I need all this. You don't need all of that stuff. If you're making decisions based on indicators, that's fine, that's cool, it makes a lot of sense. They're very useful when used under the right conditions, but you don't need them all the time. If you want to see where your indicator is, put it on, but then minimize it. I recommended, and one of the best things I ever did was just clean everything off. You know, look how clear things become when you just clear everything off. I've done the same thing with you up there. Just clear it all off and look at pure price. Oh, now I can see we've gone to highs, we've gone to lows. The supply demand is shifting. Then by all means, you're like, hey, you know what? I want to start to look for a buy when we hit that moving average. Put your moving average on. See where we are. How far away are we from it? Okay. Do I need to be alerted to it yet? Do I this? Do I that? Minimize it again. But get used to having your charts with not much stuff on it. All right, number 3, guys. Too many trades. A big one, this a big lesson for me too. Just cut your trades down. It's a very easy fix, is just to say to yourself, hey, you know what, especially if you're day trading, it's so common to get caught up in trying to trade stuff. You know, you're here, you're scalping away, you see movement, you want to get on this, you want to get on that, you want to get on reversal, you see head and shoulders, you want to sell the short, you want to go long. You can cut it in half. Again, coming back to the kind of the first concept of have a broad thesis of what you're trying to achieve. I am trying to achieve a breakout of prior day's high. That's my main thing for today, or an inside day, a range bound day that kind of rotates around, whatever it may be. When the market starts to behave in the way that you expect, then you start to place trades and start to capitalize and start to make money from being right. That doesn't necessarily mean taking each individual kind of chunk of time and trading each individual kind of little move you get. Keep wide, keep your thesis there, keep an eye on the bigger picture and trade within that. That will help you trade less. If that still means, if you're still trading away far too frequently, then put a hard restriction on it and say, you know what, I only trade X times a week if you're swing trading, X times a day if you're day trading. It's a big one, that, and it's a really good one for saving big losses. Okay, got 2 more for you guys. This is a big one, really, is letting one trade kill you. How many times have you let one trade really damage you? You know, I've got US dollar yen up here now. I might as well look at it now. One day or daily chart. People who shorted this thinking it was gone too far, even here, without a stop, just been completely massacred. You know, the move was big compared to the prior year. You know, we moved from kind of 104 to 118 pretty quickly, and there are hundreds of these happening every week. The point is if you're wrong, you need to get out. There are plenty of tips and tricks and methods of not letting one damage you, but ultimately it comes down to discipline, sticking to your risk management, sticking to your stops, and making sure you pull the plug when things aren't working for you, regardless whether you're swing trading, day trading. Otherwise things get nasty, and it takes 1 or 2 trades to wipe out all the good stuff. And I'm going to do another video on that, so stay tuned. If you haven't subscribed, hit the subscribe button. There's another video coming. I'm going to go into a lot more depth about that and how we can really overcome that issue, that problem of 1 or 2 trades just wiping out all the good stuff. And the last thing I've got for you guys is using the wrong tool for the job. You need to identify the kind of market you're in. Again, let's look at this yen while we've got it up here. Why not? This in front of your screen now is a trending environment. Okay, we have a downtrend in place. That's it. There's no arguing about that. It doesn't need any more explanation. We're downtrend. We've gone from top left to bottom right. Simple. You need to use a tool, a strategy, a technique that works in that market, in a trend, in a downtrend, that's that sort of angle with that sort of rotations. You know, we're not talking a brutal sell-off here. We're not talking a shallow drift. There's so many different types of markets. It's not a range-bound market, or is it a range-bound market with a downtrend? You kind of got to say to yourself, hey, this is what I'm trading, and I'm going to use the right tool for the job. If we then look now at, say, euro in this time period, it's range-bound. Okay, we're a very short uptrend, but if I'm taking into account all this stuff over here, let me just remove this. We're in a range. We've been up, we've been down, we're kind of chopping around. Their midpoint's about 1.34. You get the idea. So why would we use some sort of aggressive momentum tool when we're in a range-bound environment? We want to be using mean reversion type trading strategies, and you can see that even with kind of within the bigger picture on a kind of micro level, if you like. The rotations are bigger, up and down, we're swinging back and forth, getting swing lows, not much continuation before a retracement, not much continuation before a the general theme of it is that wavy nature, as opposed to going back to yen. Let's go back to yen, let's have a look at that again. As opposed to this kind of condition here, this sort of period here, where it's just one-way street. There's no two-way trade about it. Any rotations are very, very small before they're bought aggressively again. So don't be using a mean reversion strategy within it. And I know some of you say, well, there's plenty of mean reversion to be had intraday and stuff. Yes, there are opportunities there, but it doesn't make any sense to do it. Align yourself with the broader market conditions and it will help you so much more. It's just putting the wind behind you. It's like, it just makes life so much easier when you're discarding any trades that are going against the kind of overall feel, and aligning yourself with the overall feel is far better, because it allows you to, you can make some mistakes and get away with it. You know, if you're buying this and you're going long, even if you have the worst entry ever, you're still going to be okay with it. With the range bound, if you're selling extreme, let's go back to that Euro US dollar chart. If you're selling, let's get rid of some of the drawing. If you're selling kind of highs, even if you're kind of early to it, you're going to get away with it, because most of the time, you know, it's rotating. It's a rotational type environment, and if you don't, it's not going to rip off to the sunset. You've got your stop there. You're going to get pinged out. So, just aligning yourself with the market conditions. I can't emphasize how important that is from a kind of operational perspective. So what have we got, guys? We've got stops too tight, trading with too much noise, too many trades, swing trading or day trading, letting one or two trades kill you, and using the wrong tool, wrong trading strategy for the market conditions. Those are 5 trading traps that I see a lot of people falling into. When I say a lot of people, I mean me as well. So be careful out there, keep your risk manager, whatever you do. Good trading. See you in the next one, guys. Bye-bye.